Title: The Smart Way to Start Investing with Your First $100. Imagine a regular Tuesday. You finally find yourself with an extra $100 in your account, not needed for your rent, groceries, or phone bill. You decide it's time to start investing. You turn to platforms like TikTok or YouTube, immediately flooded with flashy promises like turn $100 into $10,000 in a month. Jump on this crypto before it skyrockets. This penny stock is the next big thing. All you want is a prudent strategy, not a reckless gamble. The truth is, your $100 is sufficient to kick off investing, yet it's also the amount many squander chasing after quick wins. Losing that initial $100 can lead to more than just a financial setback. It can derail confidence and deter further investment efforts. This video aims to guide you in wisely investing your first $100, helping you dodge common pitfalls newbies often fall into. I'm Jack, and if you're unsure about how to invest your first $100, remember to click the subscribe button and give this video a like. Many people believe the key is discovering the ultimate investment, as if a magical stock or crypto exists. But that's not the case. Your first $100 is about laying the groundwork. It's about transforming yourself into an investor who acts consistently, thoughtfully, and habitually. The true distinction between those who accumulate wealth and those who don't is often found in behavior, not intellect. Beginner investors are derailed by fear, excitement, ego, and impatience. According to a Dalbar study, in 2024, while the S&P 500 returned over 25%, the average equity investor only saw a 16.5% return. This disparity isn't due to a lack of intelligence, but because of ill-timed buying and selling. This video will tackle two tasks: outlining a straightforward plan for your first $100 and aiding you in sidestepping the mental traps that make people give up. Start with this. One question to ponder before diving in. Before investing that first $100, ask yourself if you need that money back quickly should an unexpected expense arise. If the answer is yes, investing might not be your immediate step. A Federal Reserve report highlights that only about 63% of adults could handle a $400 emergency cost using cash or savings. Astoundingly, 18% stated their maximum emergency expense capability was under $100. If you end up needing to liquidate your investment at a terrible time due to unforeseen bills, you haven't benefited from investing, you've suffered. That leads us to my suggested strategy, the three-bucket approach. Consider dividing your first $100 into three distinct categories. Bucket 1 is safety. Bucket 2 tackles high-interest debt. Bucket 3 is for genuine investment. Let's break these down. Bucket 1, your security net. If you lack any emergency savings, the wisest move might be parking that $100 in a savings account. Yes, this might not seem like investing, but it is. Investing in your capacity to stay committed when real opportunities arise. When facing financial pressure, logical analysis of long-term returns is often overshadowed by immediate needs for cash. This feeling is called loss aversion, where losses weigh more heavily on our emotions than equivalent gains, causing new investors to panic sell at poorly timed moments. Having even a modest emergency fund can mitigate this. Next, bucket 2. The assured return. If you're dealing with high-interest credit card debt, prioritizing that can be a stellar investment. For example, reducing a credit card balance with a 25% interest rate is akin to securing a certain 25% return, returns the stock market doesn't promise. Thus, if high-interest debt is looming, funnel your first $100 there. It's not about deeming investments bad, but recognizing a leak that needs plugging first. Lastly, bucket 3. Authentic investment. Suppose you have a slight emergency buffer, lack pressing high-interest debts, and can afford to let that money be. Now is the time to invest, and here's the truth. Your initial $100 shouldn't target individual stocks, meme coins, or penny stocks. Sure, luck is possible, but that isn't investing. That's lottery behavior. The smart path is straightforward. Aim for the entire market at minimal costs. This is typically achieved by selecting broad index funds, such as a total market index fund, an S&P 500 index fund, or a target date index fund. Why are these preferable? Even the best professionals find it tough to consistently outpace the market. In fact, data comparing active management against market performance indicates the majority end up trailing behind broad market indexes over prolonged periods. So if seasoned experts struggle, it's unlikely a beginner will succeed with a mere $100 investment. Here's how to go about it for real. Step 1. Select the right account. Generally, in many regions, the preferred order is an employer-sponsored retirement match, followed by a tax-advantaged retirement account and then a standard brokerage account. Although the names might differ globally, the core principle is to seek out accounts with minimal fees and maximum tax efficiency. Step 2. Pick one fund. Resist complicating this process. Choose one well-diversified index fund, whether it's a total market, S&P 500, or a target date fund. A target date fund essentially offers a pre-constructed portfolio that automatically adjusts as the years go by. Step 3. Make the investment. Numerous brokerages offer fractional shares, allowing you to invest less than the cost of a full share. Purchase the fund and you're officially invested. Step 4. Set up automated ongoing contributions. This is the true key. The initial $100 is minor in importance. It's the ongoing habit that counts. Automate small sums, whether $10 weekly, $25 weekly, or $50 monthly. Consistently automated investments outperform mere motivation. Historically, U.S. stocks have seen returns of around 10% per year before inflation over extensive periods. Adjusting for inflation, the long-term real returns typically hover around 6 to 7%. If you were to only invest $100 once and let it grow at 7% annually, after 30 years, it would be roughly $760. Not earth-shattering, but consider this. Cultivating the habit alters outcomes dramatically. Continue investing $25 every week for 30 years at that same 7% return, and you might end up with around $120,000 in the end. This isn't due to clever market timing, but through unwavering consistency. One quiet enemy is fees. They're mundane, which is precisely their risk. Certain actively managed funds may charge approximately 1% annually, whereas numerous index funds might only charge about 0.05%. Though the difference appears small, over decades it's substantial. In simple case studies, a low-fee fund might expand over 30% more than its high-fee counterpart across a long timeline, which is why starting with low-cost index funds is often a prudent choice. So why do people continue to deviate? If the formula is straightforward, why isn't everyone investing this way? Our brains are the culprit, often working against this simplicity. Our minds crave intrigue, making index funds seem dull. Trading provides a thrill. We dislike admitting mistakes, leading to panic selling when values dip. We also covet control. Choosing stocks feels empowering, whereas buying a broad market seems passive. Ironically, the less intervening, the more one tends to win. Here's the essence of the plan. Build your emergency reserves if they're missing. Diminish high-interest debt if present. If you're in a position to let your investments sit, invest in a low-cost, comprehensive index fund. Once that's done, establish automated contributions. Above all, maintain consistency without being swayed by boredom. Most never place that first $100 into investments not due to inability, but from awaiting an ideal moment. Those who manage to grow wealth don't depend on perfect timing. They establish stronger systems. Here's a challenge for you. Within the next 24 hours, take action. Place $100 into a crisis fund, invest it into a broad index fund, or prepare your account for future investments. Then, automate your contributions, even a modest $10 at a time, because one day you'll notice the most profound change isn't in your finances, it's in you. If this resonated with you, consider subscribing, giving a thumbs up, and commenting, "I'm starting with my first $100. That way I'll know you're genuinely on this journey, not just contemplating it.